Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. 8 weeks ago we saw the top of the recent market capped by the upper tine, currently 797, of the March to July bullish shift pitchfork. This is a shallowly bullish pitchfork, but one should not underestimate its power. Anyway, prices started and continue to stutteringly move lower, most recently being held up by the middle tine, currently 711, of the same pitchfork, in combination with the lower tine, currently 743, of the more steeply angled bullish Andrews pitchfork for the same move. The support was not perfect, as prices punched down through it 4 weeks ago, as well as the rising short medium moving average, currently 725, and the flatlining medium moving average, currently 699. Prices dropped down to challenge the important January 2021 high at 693 and the 50% Fibonacci line of the whole of the 2021 move at 689. Now both these buckled, but they eroded enough of the bearish incentive that when prices approached the next support below, which is the important 50% absolute Fibonacci line at 675 and the 50% Fibonacci line of the big old 2012-2015 move at 670, along with a slowly rising long moving average, currently 678, these supports were better able to deflect the bearish incentive enough that they were not even tested and prices rose back up 2 weeks ago. Now the rise has not been smooth, well, not been as smooth as a decline. Prices have spent a lot of time outside the lower tine, currently at 743 of the March to July bullish Andrews pitchfork. That was why, this was why I was prompted last time to draw a new July to September bullish Andrews pitchfork. The lower tine of this pitchfork, currently at 733, as well as the original lower tine of the original bullish shift pitchfork, have combined to force prices together and higher, back up over the middle tine of the bullish shift pitchfork. Okay, I know there's a lot to get hold of, but please feel free to rewind and play this again, and you'll see that it does actually make sense. Now, last week I put forward a caution about a possible very, very large double top, Adam and Adam type. Instead, I would suggest concentrating on the two separate bullish Andrews pitchforks and also that bullish shift pitchfork. These seem to be the dominant patterns right now, rather than any idea of a double top. Chicago corn. As I mentioned last time, the most important feature here was the move down below the long moving average, currently at 557, especially the second time, done 5 weeks ago. This proper break below the long moving average hasn't happened well since really November 2019. The questions I posed for the last two times were, would the market exploit this move lower? And if it did, which pattern would it choose? Well, the first bit was a bit easy, though it was done with some style 5 weeks ago with a weekly key reversal down. However, prices hesitated around the combination of the 61.8% absolute Fibonacci line at 525, which is also the 2014 high. Eventually, prices did move below this key combination of support, and they did it with two patterns: a sideways triangle and a descending triangle. Now, the sideways triangle was formed on the top side by the 2-pointer downtrend, currently at 555, from the start of July, and broken indeed actually, the August to date uptrend, currently at 573, and now with his departing partner, the long moving average, currently at 557. This had a potential target in the 509 area, which was achieved 4 weeks ago. The descending triangle utilizes the same June to date downtrend on the top side and the flat base of the previously mentioned key combination of the 61.8% absolute Fibonacci line, that's at the 525 area, and the 2014 high at the same level. This now has an initial target below in the 475 area, with a secondary target in the 425 area, right on the 50% absolute Fibonacci line. All well and good, however, the market has some other ideas, and over the past 2 weeks prices have risen enough that we've moved up back over the 61.8% Fibonacci congestion, and all the way till last Thursday prices almost touched the rising long moving average and the downtrend. So what does this mean? Well, the obvious choice is that the drop down to the start of September was a forced break lower, and I can see the point of that. However, these markets, like life, are usually a lot more complicated than that, and I think this may be the case here. You see, the move back up over the last few sessions has seemingly been a disguised period of indecision, as can be seen by last Thursday being a long-legged indecisive spinning top, which can also be seen as a countering bearish harami, plus as an outside day. Now, admittedly, last Friday was a bullish engulfing pattern, not the hardest thing to do after an indecisive spinning top, yet it also has so far had no follow-through higher, a distinctive point. This earlier indecision now, upon approach to the long moving average, the downtrend, and now also the declining medium moving average, currently at 558, well, this seems like it may also be a false move higher. At least right now it does. Hence I would suggest paying close attention as to what happens at these two moving averages and the downtrend. Because though I currently see a possible reversion back down, I'm also quite happy to start targeting the top side, as well as, but only, on a confirmed break higher. So keep an eye on it all. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.